Greetings, everyone. Today, we're going to explore one of the most famous or infamous episodes in modern financial history, the spectacular rise and fall of long-term capital management, or LTCM, as I'll be referring to it. It's a fascinating story that blends brilliance with blindness, genius with hubris, and ultimately one that reveals a lot about the interconnectedness and fragility of the modern financial system. Our story begins in the 1980s, inside the bond trading powerhouse Salomon Brothers. At the time, Salomon was the place for bond trading talent. It was loud, aggressive, and extraordinarily profitable. One of its most successful groups was the Fixed Income Arbitrage Group, headed by John Merriweather. Merriweather wasn't your typical Wall Street trader of the 1980s. No shouting, no bluster. He was quiet and calculating, interested in quantitative models of trading before quant was even a word. The team he put together sought not to speculate on market direction, but to exploit small, apparent mispricings between related securities, particularly in the government bond markets, using models based on mean reversion. That is, whenever the price or interest rate of a security or bond, whatever fell above or below its long run average, it would eventually return to that average. For example, if the yield on a 30-year Treasury bond was higher than its long run average, Meriwether and his group would borrow the bond and sell it short, profiting when the yield fell back in line with its long run average. In actual practice, Meriwether and his bond arbitrage group would generally look to add a second leg to such convergence trades. One of the most common involved selling the most recent or on the run 30-year Treasury and buying the 30-year Treasury from 6 months prior. As you can probably guess, the yields on these two securities were virtually identical, measured in hundredths of a percentage point. However, there was a slight liquidity premium attached to the on the run bond, the literally most liquid 30-year Treasury, which would drop off once it too was off the run, and at that point the two yields would snap back together. Again, such convergence trades were a specialty of the bond arbitrage group at Salomon and would become the backbone of LTCM's early success. Markets in the 1980s and 1990s weren't nearly as efficient as they are today, and there were very few playing the game Merriweather and his team were playing. And as a result, their team made a fortune for Salomon Brothers. It was right around this time, however, that the firm was rocked by scandal. When a trader under Merriweather's supervision, Paul Moser, admitted to submitting a false bid in a treasury auction, a serious violation of securities law. Merriweather himself wasn't implicated, and he passed it on up the chain of command. However, nothing was done. Moser wasn't suspended, and Treasury wasn't even notified. Then it turned out that Moser had actually lied by omission when he had confessed, for he had actually submitted many false bids in many Treasury auctions to the Treasury many times over, and Treasury found out. Rightly or wrongly, Merriweather became the firm's fall guy, and he left Salomon in 1994 under a cloud of scrutiny. However, when he left, he took along with him much of his old team to start something new, and that something would become long-term capital management. Merriweather launched LTCM in 1994, and he had a vision to combine the smartest minds in finance with the most sophisticated models to systematically extract profits from global markets with a scientific precision. And apart from the core of his old bond arbitrage group at Salomon, he recruited an all-star lineup, arguably the most credentialed team ever assembled in finance. He had Myron Scholes and Robert Merton, both soon to be Nobel laureates for their work on option pricing theory, the famous Black-Scholes-Merton model. And they had David Mullins, a former vice chair of the Federal Reserve, and Eric Rosenfeld, a Harvard finance professor. The pedigree was dazzling. Investors were soon clamoring to get in, and investment banks too clamored to cozy up to the fund. LTCM raised over 1.3 billion at its launch, an unprecedented sum for a hedge fund in the mid-1990s, and it immediately began trading with additional leverage, courtesy of the investment banks eager to partner with it, that would multiply that capital many times over. And this is a critical element to the story to keep in mind as we go along. Recall, the trades Merriweather and his group were targeting profited only pennies per $100 invested, and only by applying leverage on the order of 20 to 30 times its capital could these trades make real money. And boy, did LTCM make money, at least initially. In its first few years, LTCM's returns were truly dazzling. After its fees, which were higher than any in the industry, the fund returned over 20% in 1994 and over 40% in 1995 and 1996. But while Wall Street whispered in awe that the smartest men in the room had cracked the code, serious trouble was brewing. Recall that LTCM's primary strategy, as at Salomon, was fixed income arbitrage, and more specifically, convergence trading. In essence, they would identify pairs of similar securities whose prices had diverged slightly. LTCM would then bet that the spread between them would narrow or converge over time, thus netting the firm a neat profit on both ends of the trade. They applied this principle across many markets: US Treasuries, European government bonds, interest rate swaps, mortgage backed securities, even emerging market debt. Each trade was small and expected profit, maybe just a few points, but with extremely high statistical confidence according to their models. And to make those tiny spreads meaningful, LTCM was using massive leverage. At its peak, the fund's balance sheet exceeded $125 billion, supported by just $4.7 billion in equity. That's a leverage ratio of about 25 to 1, and even higher if you include derivatives exposure. This leverage magnified the small profits into enormous gains, but it also meant that even small market movements in the wrong direction could wipe the firm out. And unfortunately for LTCM and its investors, 1997 and 1998 would feature large market movements in the wrong direction, ultimately spelling the end for LTCM. Before moving on to that, let's take a look at some of the issues that would lead to the undoing of Merriweather and his team of financial market superstars. First, LTCM's success at pushing bond prices together, along with other firms who were beginning to copy their strategies, made it much harder for the firm to make money on the convergence trades that had been its bread and butter, leading LTCM to branch out from the bond market to areas where it had no prior experience, such as equities, options, engaging in risk arbitrage, and the sale of equity volatility, two strategies that would eventually cost the firm dearly. Even more costly, however, was the second problem. Though LTCM's traders were branching out, its positions in a variety of markets reaching into the many tens of thousands, 60,000 at their peak, they were all essentially the same trade, that things would be like they had been, simple mean reversion. In short, despite all outward appearances, and the firm was anything but transparent, LTCM was not diversified. All its trades were the same and would be undone by an underlying issue: its models. Recall, the foundation of LTCM's approach, as at Salomon previously, was its models, elegant, mathematically rigorous, and based on historical data. However, the firm's models were calibrated using the relatively tranquil data of the late 1980s and early 1990s, a period of low volatility and very stable correlations across assets. They assumed that extreme market movements, like credit spreads widening significantly and staying wide for an extended period of time, were incredibly rare. For instance, LTCM's models might tell them that a given spread widening by 30 basis points was a 1 in 1,000 event. But as we know, history doesn't often behave like a normal distribution. Thus, following their models, the firm's approach was essentially to sell liquidity and buy convergence, essentially taking a premium for holding a less liquid asset, read more risky asset, a trade that works wonderfully when markets are calm and liquidity plentiful, but collapses when fear and forced selling dominate. Cue the 1997 East Asian financial crisis and Russian sovereign default. In 1997, the Asian financial crisis began with the collapse of the Thai baht and spread across emerging markets. Investors fled risky assets and rushed into the safety of US Treasuries. Only the most on the run would do. The result was that spreads widened sharply as liquidity dried up, the exact opposite of what LTCM's convergence trades expected. The fund took losses, but they were initially not catastrophic ones, and the fund managers remained confident. The models, after all, said these dislocations were temporary. But in August of 1998, the situation worsened dramatically when Russia defaulted on its debt and devalued the ruble. Investors again panicked. The global flight to quality intensified. US Treasuries soared in price, while every other category of bond, even those with little connection to Russia, fell sharply. The spreads LTCM had bet would narrow had instead blown out even further. Positions that were thought to hedge each other were now moving in the same direction, against them. Correlations between assets, as they do during times of crisis, were all going to one. And because LTCM was so highly leveraged, its losses quickly spiraled. By September of 1998, LTCM had lost over $4 billion in its equity, more than 90% of its capital. Its balance sheet was collapsing, and because it had counterparties at nearly every major financial institution, from Goldman Sachs to Merrill Lynch to Deutsche Bank, the risk of contagion was enormous. And so it was at this point the Federal Reserve Bank of New York, led by William McDonough, stepped in. To be clear, the Fed wasn't legally empowered to bail out a hedge fund, and it didn't directly inject any money. But because it feared that an uncontrolled collapse of LTCM, given its size and interconnections, could trigger a broader financial panic, so the New York Fed orchestrated a private rescue. Playing the role of coordinator, it got 14 of LTCM's largest creditors and counterparties, such as Goldman Sachs, JP Morgan, Merrill Lynch, and UBS, to agree to contribute almost $4 billion in new capital to stabilize the fund in exchange for taking over 90% of the fund's equity. As a result, Merriweather and his partners were left with virtually nothing, while the fund was effectively nationalized by Wall Street itself under Fed supervision. By early 2000, LTCM's positions had been largely unwound. The investors who participated in the rescue ultimately recovered most of their money. But LTCM itself was finished. The smartest men in the room had blown up spectacularly. So what went wrong? First, overconfidence in its models. LTCM's founders believed their quantitative systems could capture and price risk precisely. But financial markets aren't physical systems. They're composed of people, institutions, feedback loops, psychology. What seems like a 1 in a million event statistically on paper may happen far more often in the real world, so-called fat tails or black swans. Second, leverage multiplied and magnified its fragility. LTCM wasn't undone merely because spreads widened. It was undone because its enormous leverage meant that even modest moves caused catastrophic losses and margin calls. When lenders demanded more collateral, LTCM then had to sell assets into falling markets, deepening its own crisis. Third, liquidity risk was ignored. In times of panic, assets that appear uncorrelated suddenly move together. Liquidity evaporates, and markets behave in nonlinear ways. LTCM's models assume that trades could always be unwound at reasonable prices, an assumption that failed catastrophically in 1998. Lastly, LTCM was not diversified. All LTCM's bets were essentially the same. Whether in bonds, foreign exchange, equities, or derivatives, they were all bets that markets would calm down. In the short term, the LTCM crisis didn't cause a global financial collapse. The Fed's coordination of the rescue worked. The panic subsided and markets stabilized. However, it both extended a troubling trend and foreshadowed a future crisis. Regarding the latter, it demonstrated how tightly coupled the global financial system had become, and how the failure of one highly leveraged institution could threaten the entire system. Sound familiar? It probably does, because a decade later, the possible collapse of the investment bank Bear Stearns would reprise many of these themes on a larger scale. As to the troubling trend the Fed's intervention continued, LTCM reinforced a powerful belief that the Federal Reserve would not allow large interconnected financial institutions to fail. This belief had roots stretching back to the 1980s. Illinois Central, the Latin American debt crisis, and later tequila crisis, in which the U.S. Treasury and the IMF stepped in to protect American investors and banks from losses on Latin American bonds. To critics, the LTCM rescue looks like an extension of the same principle, privatizing profits while socializing risks. If hedge funds and banks believed the Fed would always organize a rescue when things got bad, why not take more risks? This moral hazard, the tendency to take greater risks when one is shielded from the consequences, became an enduring feature of global finance, and the LTCM was part of a long string of troubling precedents. Even entities beyond the banking system could become too big to fail. So what lessons can we draw from the rise and fall of long-term capital management? First, that brilliance does not equal omniscience. Nobel laureates and sophisticated models can still be blindsided by events their theories deem statistically unlikely to the point of impossibility. Second, leverage transforms small errors into existential threats. What's safe in theory can become deadly in practice when multiplied 25 or 50 times over. Third, that risk in the financial system is never isolated. In a world of derivatives, repos, and counterparty exposure, one firm's downfall can threaten the entire network. And finally, the government and central bank interventions, however well intentioned, can sow the seeds of future crises by convincing investors that someone will always step in. LTCM's collapse was a warning, a small scale rehearsal for the global financial crisis of 2008. It showed that when faith and statistical models meets cheap leverage and moral hazard, disaster is only a matter of time. John Merriweather later launched new funds, but none matched LTCM's brief brilliance. Myron Scholes and Robert Merton continued their academic work. And in the end, LTCM's story reminds us that in finances and physics, the models work until they don't. And when they don't, the consequences can shake the world.